A new report shows older Americans are drowning in student loan debt as they try to help their children and grandchildren pay for school. Sean Dowling, at Sean Dowling TV, has more. Buzz 60. You might not use the word good to describe student loans, but not all of them are bad. A truly bad loan has high interest rates, few repayment options, or little help if you have trouble making payments. Taking time to assess loan features is key to avoiding a bad one, says Kevin Fudge, Director of Consumer Advocacy and the Ombudsman for American Student Assistance, a nonprofit focused on helping students pay for college. Before evaluating any loan offer, first maximize whatever free money you're eligible for. This may include grants, scholarships, and work-study. Then, consider these 3 borrowing tips to avoid the bad student loan. More, credit card debt versus 401k investing. Which should you focus your financial resources on? Opinion: how can people repay student loan debt if states take away the licenses they need to work? More, average starting salary for class of 2018 tops $50,000. How to make the most of it. You can choose the repayment strategy that will boost your psyche or the method that will cost less over time. Video provided by Newsy News. Look 1. Choose federal loans. For Steve, you have to borrow. Choose federal loans before private. Loans through the federal government offer more borrower-friendly options, such as income-driven repayment and public service loan forgiveness, and don't require established credit. If you're left with a payment gap to fill, compare offerings from a variety of private lenders. At Metropolitan State University of Denver, students are counseled to seek loans with trusted lender sources, such as their own bank or credit union, says Thad Spalding, Executive Director of the Office of Financial Aid and Scholarships at the university. Fudge also touts the benefits of local banks over large companies for customer service. You can walk into a local branch and talk to someone versus calling a 1-800 number and being lost in the push-button wilderness, he says. When comparing loans, decide what terms are most important to you, says Spalding. This could include a longer grace period, more repayment options, the option to release a cosigner, and opportunities to hold off repayment temporarily. A new study shows millennials are delaying life events due to being in debt. Elizabeth Keating has more. Buzz 602. Check forbearance terms while repaying your loan. You may run into difficulty meeting monthly payments. One way to avoid missed payments is by utilizing forbearance. It allows you to pause payments on your loan for a short period of time, while interest continues to build. Forbearance is typically offered in 3-month increments, for up to 12 months. Some lenders may offer up to 24 months of forbearance. If a lender doesn't list its forbearance option, they may grant it on a case-by-case basis. It's safer to choose a loan with a more transparent policy in place. Point 3. Choose a fixed interest rate loan and look for hidden costs. Private lenders may offer both variable and fixed interest rates. Go with a fixed rate that will stay the same throughout repayment. A variable rate may initially be lower than a fixed rate, but it can increase over time. That's because variable rates are tied to a financial market index. When the index changes, so does the rate. In addition to interest rates, look for hidden costs, such as fees. A bad loan is one that advertises a low interest rate, but has an origination fee that masks the true costs of the loan, says Spalding. Search for fees and penalties, such as an origination fee, late fee, or prepayment penalty. An origination fee could alternately be labeled loan disbursement fee or administrative fee. A new studentloanhero.com survey shows where that money is really going. USA Today Network: why the lowest interest rate matters, and how to get it. Securing the lowest fixed rate you're eligible for is important to your overall savings. Even 1% makes a difference. For example, if you borrow a $10,000 private loan with an interest rate of 6.5%, you'd pay about $3,600 in interest over a typical 10-year term. Instead, if you borrow the same amount at an interest rate of 5.5%, you'll see an interest savings of over $600. You're likely to take out several student loans over the course of your education. The added costs can mount quickly. Use a student loan calculator to see how different your loan savings can be with different rates. The lowest rates usually go to borrowers with a high credit score, or with a cosigner who does. Lenders may offer rate discounts for loyalty or existing accounts, graduation, auto-pay and on-time payments. Ask your private lender what it takes to get the lowest rate. What to do if you recently took a bad loan. Student loans are typically disbursed to your school at the beginning of the semester. You can usually cancel a private loan if it has not yet been disbursed. After disbursement, each school and lender may have its own requirements for loan cancellation. If you no longer need the money, you can typically make a written request, up to 14 or 30 days after disbursement, to cancel a federal loan. What to do if you've been repaying a bad loan. If you're already making payments on a bad loan, consider refinancing it into a new private loan with another lender. The goal is to find a loan with a lower rate and better terms. To qualify, you'll need to have a credit score in at least the high 600s and a steady income, or a cosigner who does. More from NerdWallet. How much should you borrow for college? Deferment and forbearance, how to pause student loans, current student loan interest rates and how they work. Anna Helhowski is a writer at NerdWallet, a personal finance website. Email anna@nerdwallet.com. Twitter, @AnnaHelhowski. NerdWallet is a USA Today content partner providing general news, commentary and coverage from around the web. Its content is produced independently of USA Today. Especially for debt-saddled millennials emerging from college into the workforce, it can be difficult to decide how to save for retirement while paying back loans. Consumers may fear that prolonging repayment will result in more debt. The Street read or share this story. https://usat.ly/2wige2bq